If you can't beat the market, you might as well buy the market. There's a really big reason to adopt in buying the S&P 500. And in today's video, we're going to be looking at the SPY. Now, when we start looking at the last 14 consecutive years, a majority of actively managed large cap ETFs have lost out to the S&P 500 and have lost out in a very big way. It's very hard to outperform the benchmark, and a lot of people, even that can do it for short term, when you start looking at a multitude of years, they cannot outperform looking even at the best computers, algorithms, researching data. Humans don't seem and cannot outperform this S&P 500. So what is the Spider S&P 500 ETF Trust? That is what we're going to be breaking down today. So looking at this ETF, it is the oldest and it is the largest ETF that we have, and understanding exactly how it works. Now, the ticker symbol on this one is SPY. It is run by State Street Global Advisors. It is the first ETF ever. This is the ground floor. This was number one. It tracks the performance of the S&P 500 index, comprised of the 500 largest companies in the United States. Now, the catch with this is when you start thinking about the market weighted cap, when you start thinking about the market in a big picture scenario, the top 10 holdings in here, you will know the names, but you want to know, and it's important to know the weight. When we look at Aapl, it is around 7% of this ETF. So thinking of diversification wise, where if you just have this 100% pie, when we start looking up NVDA, Microsoft, Amazon, Meta, Alphabet, Berkshire Hathaway, Broadcom, Tesla, just looking at these themselves and looking at their market cap weight, they are trillions of dollars, and they create about 30% of the S&P 500 just between those companies itself, which is kind of crazy to think that they have such a large part of the market. But also when you think about what they do and what they fundamentally do, they are in every country. They are global companies. You know, with the introduction of the web, with the introduction of artificial intelligence, which is still, in my opinion, in the infancy stages, it's going to make a really big change and a really big difference for years to come. So when you start looking, and this data was compiled by Crestmount Research between the 1900s through the end of 2023, looking at 104 consecutive years of positive returns. Think about that. Out of 123 years, which again is kind of crazy, we have seen 104 years of consecutive positive returns in the S&P 500, which is crazy, or in the market itself. So when you look at the S&P 500, it wasn't created until 1957. So they kind of back tested the ETF using a rolling 20-year average, including the dividend payout, which we know dividend payouts are a big part of the combination and of really the compounding that we see within the ETFs. So when you start looking at it, it is a super plain vanilla approach to investing. If you choose one ETF, like the SPDY or the Spider, overall the Spider S&P 500 ETF, it is going to invest you into every sector, which again is kind of easy to do because when you're putting money in there, don't have to worry about diversification, don't have to worry about anything else. It's kind of crazy when you think about investing. But of course, when you also start thinking about this, only a handful of stocks are doing the very heavy lifting within the S&P 500. And if you've heard the conversation about the Magnificent Seven stocks, the S&P 500 has enjoyed a crazy year this year so far, which is up over 25% since the last bull rally. Starting late in 2022, it has gained 66%, which again is kind of crazy to think. The economy is good, relatively speaking. Inflation, they've got it kind of under control. I believe last I seen, it was around 2.3%. Interest rates still a little bit too high, but the Federal Reserve is slowly moving those down. And the reason for the forecast, you know, a lot of people think of the Magnificent Seven. That is comprised of NVIDIA, Microsoft, Meta, Alphabet, Apple, Amazon, and Tesla. They are resulting and they really responsible for about 50% of the gains this year, which is kind of crazy. As the end of October, 7 juggernauts make up 1/3 of the S&P 500 by market cap, but are responsible for 50% of the gains, according to Bank of America. That's the reason why when you start thinking of these companies and when you start getting into these very large tech companies, it's important to know putting money into something like this is instant diversification. You are going to be spread among all of these different industries. And even though, again, when you think about the market itself, the US markets are about 50% of the global markets. Of that 50%, 80% of this is the S&P 500. So again, when you start thinking about investing into individualized companies, when you start thinking about where it is kind of headed and how the index trades and how the index works, these companies in the future, I feel, are going to be much higher. Putting money into something like this ETF, me personally, I put money into the VOO, which is the Vanguard S&P 500 ETF. So very similar, they track the exact same identical index. A lot of people say to do this one because I believe it is a 0.01% cheaper when it comes to the cost. But overall, looking at the valuation and what the price and earnings ratio is also important, because when you look years ago, it was about, 19, 20%. Today, it's gone well over 30, and it continues to climb when you start looking at these huge Magnificent Seven companies that are doing incredibly well. When we think of companies like NVIDIA, that is posting around a 2,600% return in the last 5 years. Yes, I said that right. 2,600% return over the last 5 years. It doesn't seem like the momentum is going anywhere. It doesn't seem like, especially having a new president, that it's going to be a lot more about big business. When the price comes down, when the Federal Reserve lowers interest rates, it makes money cheaper. It gives the ability for smaller companies, it gives the ability for larger companies to borrow more money at a discounted rate, meaning that they can borrow an absorbent amount of money or a ton of money at a very cheap rate. And that, of course, is going to slingshot out of artificial intelligence when they're starting to look at some of these companies building nuclear reactors because they require so much power to run the cloud computing, to run a lot of different things. It's kind of crazy. When you think of buying, any of our ETFs that really track the S&P 500, it doesn't make sense to not buy something like this. It's kind of crazy. When you start thinking of stocks, there is shorts. People are shorting stocks. They are longing stocks. There's a lot of different things which markets can remain really irrationally longer than they can solvent. They can be around for a ton of time. And again, thinking of how far the market and the investments in companies goes back, it's kind of crazy. Second, the bear markets are short-lived events. They tend to be measured in months, where bull markets can go on for a multitude of years. Every single bear market has been followed by a bull market that wiped away all of the losses experienced and has gone to new highs almost every single time. Even looking this year, we have seen a multitude new highs to the S&P 500. We've seen a lot of new highs to the NASDAQ, to the Dow. We have seen an incredible amount. And even if an ETF tumbles, if the ETF goes back, even if they draw back, guess what? If you are dollar cost averaging into these ETFs, you're buying it at a discounted rate. For me, it is really something, and Black Friday is tomorrow. Today is Thanksgiving. Happy Thanksgiving to you. But if you're looking at buying something discounted, when the market starts pulling back, that is the time you need to be investing more money through dollar cost averaging, because overall, you're going to get more bang for your buck. If you're looking at and consistently buying into the market, when the market is going down, as soon as it turns around, which it always has for all of history, it is going to be impressive with the returns that you see when the market does do that turnaround. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.